VOO is the gold standard of index investing. It's simple, reliable, and gives you instant ownership of 500 of America's biggest and strongest companies. For millions of investors, it's the go-to choice, and honestly, it deserves that reputation. But here's what most people don't realize. VOO alone might actually slow you down, not because it's risky or broken, but because it's incomplete. VOO gives you stability and growth, but it leaves out two key ingredients that accelerate wealth: dividend income and global opportunity. Without those, your portfolio might look great on paper, but it's not working as hard as it could to get you to financial independence faster. The answer isn't to ditch VOO, it's to build around it. In this video, I'm going to show you and Josh the core risk involved with VOO and how to fix those blind spots. And at the end of this video, you'll see exactly how to combine VOO with two powerful ETFs that cover what's missing. I'll walk you through 3 easy-to-follow strategies, one if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to retire with $1 million in your portfolio. But first, let's take a closer look at what makes VOO such a favorite and what it misses. To really understand why VOO became the gold standard of long-term investing, you have to travel back to a time when the market seemed unstoppable, the 1990s. The US economy was booming, the internet was rapidly changing everything, tech companies and IPOs were everywhere. The Nasdaq surged more than 4-fold in some years during that time. Then in 2000, the dot-com bubble burst. The Nasdaq fell roughly 78% from its peak over the next couple of years. Yet through that chaos, one part of the market held together: the S&P 500, the same index VOO tracks today. Sure, it took a hit, but it didn't collapse, because it was filled with companies generating profits, paying dividends, and operating in diverse industries. Some firms like Coca-Cola, Johnson & Johnson, and Chevron kept selling products even as the tech hype collapsed. While the S&P didn't collapse like the Nasdaq, it's clear a portfolio tied only to high-flying tech could get crushed. A broader profit-oriented base holds up better. That's where VOO draws its strength, owning the backbone of American capitalism, 500 of the largest, most established companies driving the US economy forward. And when you look at the price returns, it's easy to see why investors trust it as their foundation. Over the past year, VOO returned 18.55%. Over 5 years, it nearly doubled with a 96.76% gain. Stretch that to 10 years, and you're looking at 238.38% total return, meaning a $10,000 investment grew into over $33,838. And it does all of this with near zero friction. Its expense ratio is just 0.03%, which means for every $10,000 invested, you're paying just $3 a year. That's practically free. When you look inside VOO, you're basically seeing a lineup of America's biggest success stories. We're talking about companies like Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, Tesla, and Berkshire Hathaway, the giants that keep the economy moving. The top 10 make up almost 39% of the fund, giving you strong exposure to the country's most innovative businesses, while the other 490 stocks keep things balanced and steady. And it's not just a tech play. VOO spreads your money across multiple sectors, about 36% in technology, 13% in financials, 11% in consumer companies, 10% in communication, and nearly 9% in healthcare. That mix means you're not betting on one story or one industry. You're owning a slice of the entire American economy, moving right along with it. Even its dividends reflect that steady balance. VOO's dividend yield sits around 1.12%, with a payout of $7.04 per share, and over the past decade, those dividends have grown by 6.17% per year. Its risk is surprisingly measured. Its annual volatility is around 18.59%, meaning that in a typical year, the price might swing up or down by roughly that amount. For comparison, many other ETFs can move twice as much, so this level of steadiness is a big deal. And if you ever need to move your money, liquidity isn't even a question. VOO has over $1.41 trillion in assets, trades more than 7 million shares a day, and averages $4.49 billion in daily dollar volume. That's world-class liquidity. You can buy or sell it instantly without worrying about spreads or slippage. So when people say just buy VOO, they're not wrong. It's diversified, it's low cost, it's transparent, and it has decades of data proving its reliability. It's the ultimate set-it-and-forget-it investment. But here's the truth that most people don't realize. VOO wasn't designed to make you rich quickly. It was designed to make you rich slowly. It captures America's growth, but it doesn't amplify it. It offers stability, but not the strongest income. Its yield is low, and it's 100% US-based, which means you're missing out on faster-growing markets overseas and stronger dividend-producing companies at home. That's fine if your goal is preservation, but if your goal is acceleration, if you want to reach retirement faster, then you can't stop at VOO, because it has critical blind spots. On paper, VOO holds 500 stocks, but in reality, nearly 40% of the fund's weight sits in just 10 companies, most of them in tech. That means when those few giants rise, your portfolio soars, but when they stumble, everything falls with them. That's concentration risk, the kind that's invisible until it hits. We've seen this before. In 2000, when the dot-com bubble burst, diversification on paper didn't save investors from losses because most funds were overloaded with the same types of companies. The same dynamic exists today, just with new names. So while VOO gives you exposure to the US market's best companies, it's not immune to cycles, it's not built for high yield, and it's not diversified globally. It's an incredible starting point, but it's not the finish line. If your goal is to simply match the market, VOO does that beautifully. But if your goal is to outpace it, to grow faster, earn more income, and build resilience against shifts in the global economy, then you'll need to go beyond the S&P 500. That's why smart investors pair it with two other ETFs that fill in the missing pieces. At the end of this video, I'll show you how to combine VOO with those ETFs that fix the three blind spots. I'll walk you through three easy-to-follow strategies, one if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to build a $1 million portfolio. But first, let's look at the first ETFs that fix those critical blind spots of VOO, the Schwab US Dividend Equity ETF, SCHD. This ETF tracks a curated group of about 100 high-quality dividend-paying stocks. But it's not just chasing high yields, it screens for financial health, consistency, and long-term performance, meaning every company in SCHD has a proven track record of growing its dividends year after year. And the results really speak for themselves. Over the past 5 years, SCHD has grown by nearly 39%. Stretch that to 10 years, and total returns jump over 109%, more than doubling investors' money. That kind of steady long-term growth shows how powerful consistent dividend-paying companies can be, even through different market cycles. What makes SCHD special is that it pays you while you wait. Its dividend yield of 3.87% is more than triple VOO's, and its 10-year dividend growth rate of 10.43% means your income doesn't just stay steady, it compounds. And when you reinvest those dividends, you're buying more shares that generate even more dividends. Over time, that steady cycle quietly builds your wealth faster than you might expect. When you look at SCHD's top holdings, you can see the balance right away. We're talking about companies like Cisco, Amgen, AbbVie, Merck, Lockheed Martin, Coca-Cola, Chevron, PepsiCo, and ConocoPhillips. These are mature, cash-rich businesses that keep making money even when the markets get shaky. Unlike VOO, which leans heavily toward tech, SCHD focuses more on energy, consumer goods, and healthcare, industries that usually hold up well when the economy slows down. Its sector mix is a great example of that balance, about 19% in energy, 18% in consumer defensive stocks, 17% in healthcare, 11% in industrials, and around 10% in technology. That mix gives you what most investors are really looking for: solid performance without the constant ups and downs. Even though SCHD feels like an active hand-picked fund, it's actually one of the most efficient ETFs out there. Its expense ratio is just 0.06%. It's also huge and easy to trade, with more than $68 billion under management. In terms of risk, SCHD holds steady with a standard deviation of 14.38, only slightly higher than the market average. That means it can wiggle a bit more during short-term swings, but overall, it stays remarkably stable for a dividend stock-focused ETF. Its balance of growth and dividend reliability makes it a solid foundation for long-term investors who value consistency over excitement. SCHD does what VOO doesn't. It pays you a dividend consistently, compounds faster, and cushions your portfolio when markets turn choppy. Because over time, income becomes stable, dividends become reinvestment, and reinvestment becomes acceleration. But even with SCHD added, there's still one piece missing. You've built strength inside the US, but you haven't yet looked beyond it. But what if the next big wave of growth doesn't happen here? What if it comes from places like Europe, Asia, or emerging markets that are just starting to take off? For this, you need the iShares International Equity Factor ETF, or INTF for short. This gives you a world of companies that operate in completely different economic cycles, industries, and currencies. It's the piece that expands your reach, balances your risks, and captures growth where the US simply can't. And it's been quietly performing well. Over the past year, INTF gained almost 20%, showing renewed strength in international markets after years of playing catch-up with the US. Zoom out to 5 years, and it's up about 47%. There are times when the US market just slows to a crawl, like the lost decade from 2000 to 2010, when the S&P 500 basically went nowhere. But during those same years, international markets in places like Asia, Europe, and Latin America quietly took off. INTF is built to capture that natural cycle. When one region cools off, another often heats up. And here's the bonus, it doesn't just give you growth, it gives you income too. INTF's dividend yield sits around 2.72%, and over the past decade, those dividends have grown by more than 19% a year. That shows just how much global companies are focusing on rewarding their shareholders, not just with stock gains, but with real growing cash flow. Inside INTF, you'll find a lineup of global heavyweights, companies like Novartis, ASML, Nestle, Royal Bank of Canada, and SAP. These are industry leaders spread across different regions, giving you exposure to markets that don't always move in sync with the US. The fund's mix is well balanced too, about 25% in financials, 19% in industrials, 10% in consumer companies, and roughly 9% in tech. Healthcare and consumer defensive stocks make up another 15%, adding stability when things get bumpy. And just like VOO and SCHD, INTF is built for efficiency. It carries a low expense ratio of 0.16%, manages over $2.71 billion in assets, and maintains solid daily trading liquidity, making it easy to buy, hold, or rebalance whenever needed. When it comes to risk, INTF is impressively steady. Its standard deviation is around 9, which is lower than most ETFs. Even with global exposure, it stays calm, with annual swings of about 16%. Its top 10 holdings make up only around 11% of the fund, so no single company or country can throw it off balance. That broad spread is what keeps INTF stable while still delivering consistent growth. When you stack VOO, SCHD, and INTF side by side, you see that they don't step on each other's toes. In fact, they fit together almost perfectly. Between VOO and SCHD, there's only about 6% overlap by weight. And even when they do share names, like AbbVie, Home Depot, Chevron, Cisco, and Coca-Cola, SCHD gives them more weight because they're dividend powerhouses, not fast-growth tech names. Then comes INTF, which adds a whole new world to the mix. Its overlap with both VOO and SCHD is literally 0%. No shared holdings, no duplicated exposure. It brings 466 completely different companies from Europe, Asia, and Canada into your portfolio. That means every dollar invested across those 3 ETFs works in a different lane, one focused on broad US growth, one on steady income, and one on international diversification. Together, they create something that's rare in investing, a portfolio that's both efficient and comprehensive, minimal overlap, maximum reach. Now that we've seen what each ETF brings to the table, let's turn that knowledge into something real, a portfolio strategy you can actually follow. Because the truth is, there's no one-size-fits-all plan for investing. The right mix depends on where you are in life and what you want your money to do for you. Meet Josh, John, and James. They're at different stages in life, and each one needs a slightly different approach. Josh is in his late 20s, focused on growth and building momentum. He's got time on his side, so he can take a little more risk for bigger rewards. His strategy, the Foundation Portfolio, splits his money into 30% VOO, 30% SCHD, and 40% INTF. That gives him the innovation of US companies, steady dividend growth, and exposure to fast-growing international markets. John is in his late 30s and wants balance. Growth still matters, but so does stability. His plan, the Core Growth Plan, leans 30% VOO, 40% SCHD, and 30% INTF. It tilts slightly toward dividend income while keeping a global reach. For John, it's about growing steadily without stressing over every market swing. Then there's James in his 50s, focused on preservation and reliable income. His approach, the Income and Stability Strategy, goes 20% VOO, 50% SCHD, and 30% INTF. It's heavier on dividends, lighter on volatility, and still diversified across the world. Each of these strategies is built on the same foundation: diversification, discipline, and patience. The mix changes with your stage of life, but the principles stay the same. Now, let's see what happens when Josh, John, and James stick to their plans for the long haul, 30, 20, and 10 years, and watch how consistent investments can quietly grow into something life-changing. Starting with Josh, who is just getting started in his career, and while he doesn't have a huge income yet, he's got the one thing that matters most in investing: time. 30 years of it. Like most people his age, Josh can't throw thousands of dollars into the market all at once, but $10 a day? That's doable. It's the cost of a coffee or a quick lunch, and that's the beauty of starting early. Small, consistent investments have decades to grow and multiply. So Josh decides to stick with that plan: $10 a day, every day, for 30 years. Here is what the projections look like. By the end of year 1, Josh would have invested around $3,650 into his foundation portfolio. By year 10, his portfolio is projected to be valued at around $65,000, generating close to $2,000 a year in dividends. It won't be retirement money yet, but it will be proof that steady investing works. Fast forward to year 20, and his portfolio will be valued at $300,000, and his annual dividend income is projected to climb above $13,000. Each reinvested dividend will buy more shares, creating an ever-growing cycle of compounding returns. 30 years from now, Josh's portfolio is projected to surpass $1.3 million and generate around $84,000 a year in passive income, or roughly $7,000 a month, enough to cover all his living expenses without ever touching the principal, all for $10 a day. Now, what if you want to reach the $1 million portfolio faster? Let's take John's example in this one, who has 20 years to retirement. He's earning a stable income and has his eyes set on retiring early. He knows his portfolio needs a balance between growth and stability. If you look at a 30-year investment chart, most of the big growth happens in the last 10 years. That's when compounding really takes off. But John doesn't have the luxury of time like Josh does. He has to make his money work harder up front, so starting with a larger base gives his portfolio the momentum it needs to reach his goals faster. He'll start with an investment of $40,000 and commit to adding $20 a day into his core growth plan. It's a realistic amount for his income level and the stage of life he's in. In the first year, his portfolio is projected to be valued at around $52,000, earning roughly $1,000 in dividends. By year 10, his portfolio is projected to grow to about $254,000, generating nearly $8,000 a year in dividends. And 20 years from now, his portfolio will be valued at around the $1 million mark, with annual dividends nearing $40,000. Finally, there's James, who only has 10 years to retire. He'll begin with $275,000 already invested and add $25 a day to keep his portfolio growing. At his age, starting strong makes sense. He's spent years building savings, and with only 10 years left to invest, putting more in up front helps his money generate meaningful income faster, while still benefiting from compounding along the way. In his first year, James's portfolio is projected to be valued at around $316,000 and generate about $8,000 in dividend income. By year 5, his portfolio is projected to reach roughly $535,000, producing about $16,000 in annual dividends. And 10 years from now, James's portfolio is projected to surpass $1 million in total value, with nearly $37,000 in annual dividend income. Want to know how to earn over $8,000 in monthly dividend income using 5 compounding strategies? Click the video on screen to find out.